Policymakers need time to draw conclusions from the incoming data and to allow some special factors that have been supporting near-term activity, perhaps limiting the impact of the higher interest rates on the economy, allowing them some time to play out. And this includes the household excess savings that I mentioned earlier, as well as firms' elevated cash holdings and the debt that was previously refinanced at low rates. So as consumer savings and firm cash holdings decline further and more corporate debt needs to be refinanced, tight credit conditions should act to restrain activity, and we'll just need to continue monitoring these trends carefully. Since it's likely that we've yet to see the full effects of our past policy conditions, patience is also needed in order to best weigh the risk of inflation remaining persistently high against the risk of activity slowing more than expected. And I expect that higher short-term rates may place additional pressure on some banks' balance sheets and reduce bank credit provision more than anticipated. I also note that before the FOMC meeting at the end of this month, we'll receive additional important data on inflation and real activity, and that'll help me as well as the committee more generally in making our decisions. So finally, as we consider appropriate policy, I think it's important to take the movements in long-term interest rates into account. Since mid-September, the 10-year Treasury yield has moved up noticeably, though it retreated a bit this week. However, on net, this yield is now somewhat higher as are corporate bond yields and mortgage rates. Several factors may be driving these overall gains in long-term yields, and it'll be important to see whether the increase is sustained, especially given the rate volatility that we've seen in recent days. Importantly, the rise in long-term yields implies some tightening of financial conditions, and if it persists, it likely reduces the need for further monetary policy tightening in the near term. This reinforces my view that we're very near and perhaps at the peak federal funds rate for this tightening cycle.